right, with the lockdown. But there's a lot of differences. I mean, significant differences. Like I said, we were trading at all-time levels, and everything was great, and everybody, market was at record highs. We're trading at these expensive valuations. Look where we're trading now. And most stocks are down tremendously, significantly. The China lockdown is mostly in Shanghai and a couple of other areas. But we have the playbook now. The companies have been finding ways to improve their supply chains, logistics outside of China, which is a little bit better. Still, a lot of people use China. And this time around, this latest strand of COVID is less than a cold, right? No one's dying from it. So, if you have underlying conditions, I'm not downplaying it, but you know what I mean. Nobody's really scared of it, and you shouldn't be scared of it. Especially if you're in good shape and you're under 50 years old, 55 years old, you have nothing to worry about at all. So, I mean, even, New York is kind of cringing in California. They're like, they want people to wear masks for the rest of their lives so bad. We need to control these fucking people for the rest of their lives. Wear masks or you're going to die. It's so sad talking to people from these areas because they are still scared shit of COVID. Because, just the media and the fucking politicians, just how they scare these people to death. I mean, I see teenagers wearing freaking masks in cars. I mean, come on, man. Holy shit. And it's not their fault. It's just, again, the politicians and control and shit like that. It's like a joke. Okay, what side are you on? You look at the facts and we're seeing how stupid, how ridiculous that was. But anyway, see how long China closes for. I think it's going to be a lot less this time. But more importantly, if you're looking at the market and if you're a Curzio Venture subscriber, you're getting 3 new recommendations today in my newsletter. Might sound crazy, but I recommended lots of new ideas in May and then in August, so 2 in one newsletter, then another 2 in another newsletter, and you could see the gains in those because there's opportunities and there's certain times we want to be aggressive. Right now, not that I'm being aggressive saying go all in, but we're taking the third position in 3 different names that are down probably 75-80% that have no business being there. And when I looked at Russell 2000, I wanted to see where the PE ratio was compared to other times. And I did it in this newsletter and did a video. I wasn't really too surprised. A little surprised that the valuation is lower than what it was in COVID. Are you kidding me? And then when you compare it to even the credit crisis, so we had the lowest point it hits is like a 20 PE. And when it hits that and it goes a little bit below, it bounces back. We're at 18 right now. The only two times it fell were the credit crisis and in COVID. And both times, it was pretty quickly, it bounced back significantly, and that's where we are. And that's what I expected to see. What I didn't expect to see is when I put up the PEG ratio. And again, I show this this is what we do with our newsletters. I'm not going to show it here. But the PEG ratio, guys, holy shit, I had no idea. So that's price, that's the PE. So you can't just take a PE. The G is growth, right? So you factor in growth. Because I always say all the time, if you look at a PE ratio, a stock can be trading at a 5 PE and be super expensive if they're not growing earnings or not expected to grow earnings. And they're not seeing sales growth. That's why it's cheap. And a stock can be trading at 30 times forward earnings and be super cheap if you're growing those earnings at 70% plus and expect to grow over the next 2 to 3 years. Right, so the G factors that in with growth. And you may say, well, some of these growth estimates have to come down. This is now. A lot of the growth estimates came, not only this earnings season, but the past 4 or 5 months, we're seeing a major adjustment in earnings. They're coming down. So this is updated, right? If you pull up that chart, I went back to 2004. I couldn't go back to 2000. I had it on Capital IQ. It just comes in with a weird chart. We're at a place that we've never been in the history of this market. PEG ratio is at the lowest point by a mile than it's ever been. Going back, it could go back all the way to 2000 or even further. I'm not sure. But you're not looking at the PE ratio. Look, you saw it a couple of times, bounce below 20 and go up. We're at a level, the lower the PEG ratio, the more cheaper and the better opportunity it usually is, right? You could be at a 1.5 and the stock continue to go higher. But when you look at the whole Russell, compared to what's expected with the earnings growth, and maybe it's not as strong as it used to be, but we're trading at a level that you've never seen before. It's worse. Are we right now worse than when we are at COVID, when we had no idea lockdowns were going? The whole world was locked down. Are we worse right now than that? I would say no. When companies are cutting their revenue by 90%, which you do not model for ever, right? Because you have no freaking idea what's going on and which companies are going to be allowed to stay open. No. We see inflation. We see all the risk. We have the risk. We know the risks. These companies, they're lowering estimates. They're still making money. They still have tons of cash flow. They still have strong balance sheets. Are we worse right now than a credit crisis? Because based on that PEG ratio for the Russell 2000, we are way, way worse than the credit crisis where we thought the financial system was going to collapse. The world going to collapse. I mean, I was on Wall Street. You should have seen it. People under their desks, literally like, holy shit, I don't know what to do. And they were going to banks to take out that money. And that was the scare on the inside. There's a reason why Kramer had that whole rant. You had no idea. He would panic. It's pure panic. That's what it wasn't. It wasn't this whole show that, hey, I want attention. It was panic because commercial paper market froze. Money market accounts, going down. It's supposed to be stable, like a stable coin, right? The same thing we've seen with money market accounts. Are we worse off now? Because right now, by that PEG ratio, it's showing that we're way, way, way worse than that, which is insane. And I'm not saying that the market can't go down further from here. Of course it could. Just like we saw in January. You look at insiders. I provided a chart of insiders. This is the most that insiders have been buying compared to any other time since the credit crisis. And they got that right. They got it wrong. So from November, you're looking from November to January, the market went, that area is one of the largest where insiders, there's tons of insider purchases and people getting excited. They were buying alongside. The market went up until January before it crashed again. And it crashed 30%. And like I said earlier, went from 940, the S&P 500 to 666. And, it was a nice decline. You're like, holy shit, but immediately bounced back. So those insiders were right. It still took another leg down. But you were right a few months later, and now look how right you were. I mean, buying at 920, whatever, and look, 3,800, 12 years later. But even, we were at 1,1300, 40% gains, 30% gains from when they bought, just like a year and a half, 2 years later. They were right. These are the people that run their companies. They know what's going on. They see their supply chain. They've gone through these problems. They've seen their stock get crushed. There's more insiders buying their stock than almost any other time in history. That's a good sign. It's not a sign that you're going to catch the bottom and invest. But for me, I told you, I'm buying a house. I have a house that's almost fully paid for. And I'm waiting to go into that house, which is going to be built in January. For me personally, I'm going to sell this house quicker because it's up tremendously over the past few months. Take that cash and throw it into the market. And that's me. And that's going to take my family where we're going to have to get an apartment for 6-9 months and then move into the house, which is a pain in the ass, but that's how optimistic I am in the market. And you see these bounce backs and they happen quick because when inflation moderates, and it will, that's going to be the catalyst where you're going to see things pop 20, 30%. Guys, I know shit's bad. I've been talking about it on a podcast forever. But right now, when you're down 35%, 40%, the biggest companies in the world, the best, the industry leaders, you get 125, 130 of S&P 500 companies trading below 10 times forward earnings and growing those. A lot of them are going to be growing those earnings much faster than that. You got to start picking away here. This is a great opportunity. And it's an opportunity, and I'm not saying this like I'm some genius. I'm saying this because I made so many fucking mistakes, especially in 2009 and during that time period. I wasn't buying. 2010, I was still bearish until I really, David Tepper really changed it for me, saying, you know what's going to go higher? Everything's going to go higher because the Fed is at zero interest rates and they're going to just throw so much money into the system. I'm like, holy shit. I'm looking at numbers over the past year and I'm looking at these companies look like shit and, the macro environment's terrible. That's not. Stop looking back. Look forward. Everything's going to be much, much easier. And when you see it right now, it's hard to see because you're like, frank inflation's through the roof. My portfolio's down. I get my ass kicked. We're close. That's close. That's a sign, right? When you could find almost no positives, that's usually the sign that, hey, you know what? Start picking away. Don't go all in. You're going to see more pain ahead over the next couple of months. But as you saw with COVID, as you saw with almost every downturn, even the credit crisis, when these things bounce, holy shit. When you see 30, 40% corrections in the market, when they bounce, it's easy to get 20, 30% gains in weeks. Especially now the earnings season's almost over where a lot of these retailers are reporting they're down 35% from their highs and they're losing another 20, 30%. Holy shit. Just because there's, it's forced selling. It's not because their fundamentals aren't there. It's people getting out of the market, being scared, but there's going to be a time when that selling is going to stop. You've seen a lot of leverage come out of the market, and we're pretty close to that time.